So we've got the market, which is still down about 25 points. Sun TV seems to be the latest casualty, 5% lower, 536 on Sun coming in. Of course, Bharti Airtel is the other one, and the Sun stock, of course, still remains about 10% lower. Let's talk about markets. Rohit Shrivastava, fund manager, PMS. Sher Khan is now with us here in our studios to take some questions. Rohit, thanks very much for joining in. So let's talk about the Nifty, the index first, and you got an interesting pattern that you want to highlight, a head and shoulders on the Nifty, which has been developing for a while. Why don't you start talking about that, the setup, and what it really implies for the index?
So the markets made two bottoms over the last year, the first time in March at around 9950 and the second time in October at 10,004. And when you connect these lines, what we call that pattern over a long period of time is a head and shoulders topping pattern. Now, to call it a topping pattern, of course, you need confirmation, which means an actual break below the 10,000 mark. But as technicians, we try to anticipate that, and there are a couple of readings that usually go with the pattern, and that one of them is the volumes. So when you look at the head, that's usually the all-time high that we made, which was at 11,700 in this year in August. The right shoulder is where you expect volumes to taper out. So the left-hand side, the market actually made a top at around 10,920. And we are very close to that same level now, which is the right-hand side. And the volumes on the left-hand side are far, far higher than where they are right now. They're almost half now of what they were back then.
Does that chart make sense, Rohit? I mean,
yes, it does. We could have had, we could have seen seen much more data. If we took a little more time, then the pattern would be more clear. But the point is that you have the high in the center, and then you have the left and the right. You're making two tops which are lower than the central part. They're almost around the same level. And the key difference is that there's a loss of volume and momentum on the right hand side.
Right.
So once you get that loss of volume, it becomes an early indication that you may be developing a right shoulder. And once you start seeing the selling, then it's a signal that you're going to break below the 10,000 mark and probably head to 9,200 or something like that.
So your conclusion is that we are essentially in a drift down.
I think so. I think this is
and the target of this pattern is 9,200 on the Nifty.
That's right, at least.
And is it confirmed? Do you want more signals for confirmation, or
in my mind, it looks okay. In my mind, it looks pretty much set up for that to happen for reasons as we will also look at the next chart, which is the internal market weakness. One of them is volume. Second is we look at the Elliott wave structure, which means that the sell-off from 11,700 is impulsive. Okay. And once we have those two, then we put a high probability on this pattern playing out. One of the ways that you can put risk at it is look at a key retracement mark. Like if you look at 61.8% of the entire setup, it's at around 11,100. Now, when we spoke in October, I was thinking of the market bouncing back to 11,000, 11,100. And we come close to that. We've really not touched that level. It doesn't look like we'll get there. If we even do, it's okay. But the point is that as long as we stay below that, it has all the signs of becoming a right shoulder.
Okay. Rohit, just talk a little more about stocks, because you've been looking at some liquid counters which are now above their 200-day moving average. Which ones are these and what are the charts telling you?
Okay, so the ones that would be above are a very, very narrow list. Of course, there are stocks like maybe Reliance Industries, Hindustan Lever, Britannia. Mostly, I think, in the consumption space, the consumer stocks, those might be up there. But most, and some of the private banks, probably now you would see ICICI, Axis Bank up there, HDFC Bank. But what the data really shows is that out of the liquid stocks, which are around 1,400 stocks, 81% of them over the last 1 year are now below the 200-day moving average versus almost 80% being above the 200-day moving average. So that's a big shift. Given that the Nifty is at almost the same level, because you're just 200 points higher than where you were at the end of December 2017, 18.
So is that indicating that there could be further upside in a couple of these stocks? Do you have any targets?
So I think we've seen that outperformance happen. Like HLL actually made an all-time high some time back. We've seen Axis do it, ICICI Bank attempt it. So I think the stocks that wanted to make new highs have already done so. Okay. And because the rest of them are not participating is what tells us there's weakness, which is why you have a right shoulder. Why is the index at a much lower level when some of the stocks are still making all-time highs?
But to be fair, we've been in this kind of situation, bipolar market for a while, right? Why can't it continue? That your bunch of stocks stay strong and the rest of the market is in the dumps.
Okay, so that's a fair question, and we've actually seen weakness in stocks many times over the last, many years. What we have seen is they also make a comeback at some point of time. So we had seen that kind of a decline in 2015. A lot of the stocks fell off, and then they made a comeback. What we have seen this time around, which is different, is that the mid-cap performance, if you take the mid-cap index relative to the Nifty itself, it has a performance cycle. So the mid-caps were outperforming the Nifty even though they were going through down cycles in terms of how many stocks are above or below the 200 DMA. That performance actually gave up a year back and has not made a comeback. It's fallen pretty sharply. If you take a relative chart of the Nifty to the mid-cap, we've seen a 20-30% cut in the relative index, which didn't happen in 2015 when you had a similar sell-off where a lot of stocks went below the 200 DMA. So this time around, the weakness is far deeper. And that's why I think it's likely to continue, because when we look at the mid-cap cycles, they usually last for, the down cycles last for around 2 years. So we've been down for around 1 year now. And my sense is in that case, you'd at least have another year of underperformance by the mid-cap space.
Rohit, we wanted to talk about one more thing, but we're being told that we're just completely out of time. So we will take that up on the next occasion. Absolutely. Well, so that's Rohit Shrivastava of Sher Khan with some interesting numbers and some perspective on the market. We take a very